Guys, it's Kevin here. Since we crossed the 100 subscriber count this month and also recently crossed 200 subscribers, I figured I'd do a more personal video to commemorate the milestone and thank all of you guys for the support so far. In the last video, I talked about DeFi and the limitless options that are out there. And today, I'll talk about my personal DeFi and crypto portfolio, why I'm expecting a relatively low risk 50% return this year, outside of any price growth in the tokens themselves. And I'll also be going through which tokens I'm bullish on, which protocols I'm using, and the returns for each of my yield farming strategies. I'll also cover how to execute the same plays yourself, so keep watching to find out more. Like I mentioned in my video introducing Ethereum and Bitcoin, I'm bullish on both tokens. My bullishness for Ethereum is even higher now compared to a month ago. And that's really because of the recently proposed changes that are going to lower the cost of transactions and reduce the number of Ethereum tokens in circulation. Given that I'm looking to accumulate more Ethereum and Bitcoin, my strategies basically revolve around holding and investing both those tokens. I'm also holding a little bit of USDC, a token equivalent to $1 because short term, I'm not sure if prices slide some more and I want to have a little bit of dry powder to deploy at cheaper prices potentially. The main strategy that I'm using for returns is called yield farming, and I'm doing that on a protocol called 1inch. 1inch is an aggregation protocol that helps you find and execute the best pricing to swap between any two tokens in a decentralized way. So, even though swapping fees can be a little bit high, once you're above a certain investment size, around I think like $15,000, it's actually cheaper to exchange this way rather than sending your assets to a centralized exchange and then swapping there. And that assumes that the centralized exchange that you're using actually supports both the tokens that you're trying to swap between. With 1inch, if those two tokens exist, basically you can be pretty sure that it's going to find a way to make that exchange happen. There are two 1inch yield farming strategies that I'm using. The first one is the ETH USDC pool, and the second is the ETH WBTC pool. WBTC is just a version of Bitcoin that is usable on the Ethereum blockchain. It's called wrapped Bitcoin. If you need a quick intro to yield farming and other topics in DeFi, check out my intro to DeFi video, linked down in the description below. Right now, the yield farming on 1inch for ETH USDC earns you about 13% in swapping fees, and those are the fees that users pay when exchanging a token that they possess for a token that they want, plus an additional 56% APY in the form of 1inch tokens, which you can earn by staking down your liquidity pool tokens. Similarly, ETH WBTC, that pool earns about 34%, a laughably low 3% from the swapping fees, but there's a juicy 31% in additional reward incentives coming from 1inch. Just yield farming on these two pools earns me roughly a combined 45 to 50% in APY, hence the title of this video. And this is not including any of the price increases that might come from institutions buying more ETH and Bitcoin, or other positive macroeconomic factors like the stimulus money-led expansion of the monetary supply, which should push up interest rates and inflation over the next couple of years. All right, you'll notice that I'm recording this on a different day, and that's because right after I recorded the first version of this video, the farming incentives on 1inch stopped. And that's because a lot of these protocols use these incentives to raise awareness and increase the amount of tokens that people are willing to deposit into their protocols. So since 1inch yield farming is no longer attractive, I've since switched over to using Sushiswap to farm the same two strategies. The rationale here is that it's basically the same as it was on 1inch, but the only downside is that the current yields on the ETH BTC is around 20 to 25%, and the ETH USDC is around 50%. So both of those are lower than they would be on 1inch. Overall, that means my current portfolio APY is closer to 35% rather than the 45 to 50% that I was earning just last month. Here's a quick demo on how to yield farm on Sushiswap. You're going to need a compatible wallet like the Coinbase wallet app or MetaMask. I'm using MetaMask in this example. Next, go to Sushiswap, link in the description down below, and connect your wallet. Click on Farm on the left-hand side. Here you can see the list of pools that you can yield farm. Click the Add Liquidity button next to the pool that you want to add liquidity to. Here I'm choosing the Bitcoin Ethereum pool. Once you select the amount that you want to invest, click Approve BTC. This is a transaction that gives Sushiswap the ability to spend your WBTC. Once that transaction is completed, you'll see that the button on the screen changes to Supply. Clicking on this button will make another transaction request show up in MetaMask, and the transaction fee here should be about $70, which isn't chump change, but that's just the current cost of investing. Once your transaction is successful, then you should be able to receive a liquidity pool token representing the Ethereum and Bitcoin that you just deposited into the pool. If you don't do anything else, you'll get a portion of the transaction fees from people exchanging between Ethereum and Bitcoin on Sushiswap. However, to get the actual stated 20% APY, you'll need to do a couple more actions. On the same farm page, click on Approve Staking. This transaction allows Sushiswap to utilize your liquidity pool tokens. Then once it's been approved, the final action here is just to stake your actual tokens. Click Stake, stake all the pool tokens you just received, then click Confirm. Again, you'll need to pay another transaction fee, but once you've done all these steps, then you're done, and you just have to wait patiently to collect your earnings. If you want to use your ETH and BTC elsewhere, just click on the Unstake button and then Remove. You can always see your portfolio of assets on the portfolio page on Sushiswap at any time. Lastly, I just want to touch upon the risks of yield farming. First is the issue of impermanent loss. Prices of tokens fluctuate, sometimes wildly. Say you have $100 of Bitcoin and $100 of Ethereum, and Bitcoin prices stay flat and Ethereum goes down 10%. If you're just holding those tokens in your wallet, you're out 5%. However, if you're yield farming, impermanent loss will cause you to lose another 0.14%. The amount of impermanent loss depends on how widely the prices of the two assets in the pool change from one another. So while a 10% price change may only incur a 0.14% impermanent loss, a 50% price change would incur an additional 2% impermanent loss. Impermanent loss becomes permanent only if you withdraw your tokens from the pool. So if Ethereum went down 10% and then went right back up 10% and you didn't withdraw during that time period, then you wouldn't have any impermanent loss. The second issue is always a concern around smart contracts. I've read through the Sushiswap contracts and haven't found any exploitable issues, but it doesn't mean that there aren't any. Like always, this isn't financial advice, so do your own due diligence before investing. There are also some alternatives that will allow you to yield farm WBTC ETH and ETH USDC. You can do this on Uniswap, though currently it offers lower APYs. And you can also do a leverage version using Alphamora, which allows you to borrow ETH and then yield farm. The returns on yield farming on Alphamora are higher than they are on Sushiswap, since you're borrowing capital to leverage your returns. The flip side is that you're going to need to manage your risk more actively on Alphamora, and that's just really due to certain liquidation risks that come from borrowing ETH. It's kind of similar to getting capital called by your brokerage if you have leverage. And lastly, there are some other opportunities in DeFi that I'm looking into around alternative blockchains, different utilities, and aggregation layer technologies. One particular layer 1 platform that I'm hoping to evaluate soon is called Terra, which is responsible for one of the only apps out there called Chai that's actually widely being used to buy things in non-blockchain contexts. And they're also building infrastructure to create synthetic assets and yield-bearing money, like stablecoins, which is pretty cool. The other project for me that I think is pretty interesting is Tornado, which is best known for its anonymization features for sending and receiving tokens. That's it for this video. If you found this video useful, let me and the YouTube algorithm know by smashing that like button and sharing the video. I just wanted to thank all of you again for supporting the channel, watching my various videos more than 4,000 times so far, and helping me cross the 200 subscriber mark. If you haven't already subscribed, I'm trying to hit 1,000 subscribers ASAP, so hit that big red button and click the bell to get notified the next time I talk about crypto, and other topics in investing. As always, thanks for watching, and I'll see you in the next video.